G'day, and welcome to this recap for the first quarter of 2022. In today's recording, I will use the opportunity to give you a brief update on markets and how that translated into the investment delivery of our funds. I will unpack the performance briefly and close up with our fund positioning and outlook for the near future. We trust this update will assist you as our valued partners during your next client engagements. Moving into 2022, the focus was tilted to inflation, the Fed's potential policy tightening, and China's disappointing growth. While none of these concerns have diminished, since then, news flow has certainly been dominated by Russia's invasion of the Ukraine. The invasion has caused a global shock, followed soon after by unprecedented sanctions. The implications of the war and the sanctions have quickly fed through into markets, which saw equities declining and bond yields rising. Commodity prices soared, given that Russia is a key producer of several important commodities, including oil, gas, and wheat. The conflict contributed to a further surge in inflation, as well as supply chain disruptions. In addition, Chinese equities were negatively affected by renewed COVID-19 outbreaks, leading to new lockdowns in some major cities. China's zero-COVID policy is certainly polarizing, if nothing else, considering the world has largely learned to live with COVID. When looking at how the economic backdrop impacted market returns, and contrary to other emerging market fortunes, South African markets broadly ended the quarter in positive territory. SA equities posted a decent return of 6.7% for the first quarter, driven by both resources and financials, both up over 19%, while industrials were down sharply, down 13%, led predominantly by further regulatory challenges for Naspers and Prosus. Nominal and inflation-linked bonds came under pressure as the yield curve flattened in March, with the war deepening stagflationary concerns. Over 12 months, the majority of asset classes, however, still enjoyed healthy double-digit returns. The general risk-off environment, coupled with the strengthening rand, up 8.5% on the back of stronger commodity prices, saw all global asset classes falling into deep negative territory when measured in local currency terms. Global equities retreated 12.2% over the quarter, with developed markets only slightly ahead of emerging markets. Turning our attention now to the returns of the Momentum Focus Fund of Fund range, we can see that it has been a largely muted quarter, with the returns largely flat, but well positioned relative to the respective ASISA peer groups, with first and second quartile rankings across the range. Over 1 year to March, the funds remain comfortably ahead of their respective peer group averages. Key contributors to these double-digit returns have been our tactical overweight tilts to local equity, nominal and inflation-linked bonds, global property, and careful management of our exposure to global equities over the past 12 months. Similarly, our underweight exposures to global bonds and local cash have added on a relative basis, while underweight exposures to local listed property have been a detractor. Turning our eyes to the future, we expect a continuing rise in inflation and tighter monetary policy conditions. Economic growth, although still positive, is starting to moderate due to higher interest rates and continued supply chain disruptions, all of which are exacerbated by the war in Ukraine. Given the relaxation of Regulation 28, or foreign exchange controls, we will look to add to our global exposure in a systematic and responsible manner over time. As is always the case, we remain well diversified across asset classes, strategies, and managers, and actively positioned for the prevailing market conditions. Thank you for listening.